What if I told you one Wall Street bank has been so dominant in silver that regulators have fined traders for rigging the market? And yet the bank still sits at the center of the whole system? So the question isn't, does silver matter? It's who's actually holding the steering wheel? Alright, welcome back. Today we re-talking silver, the metal that somehow a boomer end dash of the dash world asset, TikTok get-rich obsession, and also literally a critical industrial ingredient in the real economy. In the headline you clicked, JP Morgan just took control of the silver market. We were going to unpack that responsibly, because control can mean a lot of things. Are we talking ownership of physical metal? Influence through futures? Custody of ETFs? Market-making power? Or just being the biggest gorilla in the room? By the end of this video, you'll understand, in plain English, how the silver market actually works, why JP Morgan's role keeps showing up everywhere, and 3, what you can do if you're trying to invest without getting played. Not financial advice, just market reality, with a little caffeine. Why silver is weirdly important and everyone underestimates it. Let's start with the obvious question. Why do people care about silver so much? Because silver has a split personality. On one side, it's a money metal. People buy it when they're scared of inflation, bank failures, currency drama, geopolitical chaos, you name it. It's like the emotional support animal of commodities. On the other side, silver is an industrial metal. It's used in electronics, solar panels, medical tech, soldering, batteries, all kinds of things that make modern life modern. Meaning silver demand isn't just vibes, it's also factories, and that creates a problem. Silver is small compared to other markets. Like, if you compare it to oil or major stock markets, silver is a smaller pool. And smaller pools are easier to splash around in. A big player entering the pool doesn't just join the swim. They change the waves. So when people say someone took control of silver, what they usually mean is one or a few institutions became so big through trading, storage, and market plumbing that their actions can move price, liquidity, and sentiment. Here is the part most people miss. The silver price you see online is not set by your local coin shop. It's not set by a guy polishing rounds in his basement. Most silver pricing is heavily influenced by paper markets futures, contracts, and derivatives where a huge amount of silver exposure trades without metal physically changing hands. So if you want to understand power in silver, you don't just ask who owns silver bars. You ask who dominates futures flow, who controls a lot of deliverable inventory, who clears trades and provides liquidity, and who acts as custodian for big investment vehicles. Keep those 4 in your head. They're the keys to this whole story. The silver market in 90 seconds so you don't get lost, okay? Quick crash course, because if you don't understand this, you'll get manipulated by headlines forever. There are basically 3 silver worlds that interact. Number 1, physical silver. Bars, coins, industrial supply chains, real metal, heavy, annoying to move, but undeniably real. Number 2, futures markets like COMEX. This is where contracts trade that represent silver exposure. You can buy and sell massive amounts of silver with a tiny fraction of the money up front, because futures are leveraged instruments. Most of these contracts are closed out before delivery. Number 3, ETFs and other paper products. These are investment vehicles that track silver's price. Some are backed by metal held by custodians. Some involve authorized participants in share creation redemption mechanics. The point is, giant pools of investor demand can flow into silver exposure through a ticker symbol. Now here, the key point. Price discovery. The thing that makes the number on your screen tends to be heavily influenced by the futures market, liquidity, and activity. So the players with the most influence are often not your average investor. It's the institutions with the balance sheet, the trading infrastructure, the ability to warehouse metal, and relationships across exchanges and clearing. And yes, this is the neighborhood where JP Morgan constantly gets mentioned. So what exactly is JP Morgan's control supposed to mean? Let's get specific, because the internet loves to go full conspiracy mode. When people claim JP Morgan controls silver, they usually mean one or a combination of these 5 things. Number 1, a major presence in silver futures trading. Big banks can be major counterparties, market makers, and liquidity providers. That doesn't automatically mean evil mastermind. It does mean they see the flow. Seeing the flow is an advantage. Number 2. Large holdings or access to deliverable inventory. In silver, the ability to source metal, store it, and deliver it when needed matters. If you can meet delivery demand during stress, you become a gatekeeper. Number 3. Connections to ETF plumbing and custody. Some big funds and products rely on custodians and authorized participants to function smoothly. If you're a central node in the system, you're not just an investor, you're infrastructure. Number 4. Derivatives and hedging relationships with miners and industrial users. Banks can sit in the middle of producers and consumers. That's not inherently sinister. It's how commodity finance works. It does concentrate influence. Number 5. History. This is the spicy one. JP Morgan has been associated with precious metals controversies for years, not always at the corporate level, but through enforcement actions involving traders. That history makes people connect dots. And here's the most important nuance. Control does not have to mean they own every ounce. In markets, control often looks like being the most important doorway, the place where trades route through, where inventory sits, where liquidity appears, where panic gets absorbed. So when people say JP Morgan just took control, what they're reacting to is the perception that, over time, JP Morgan became a central node in silver, especially through the combination of trading influence and physical market footprint. Now, can one bank single-handedly set the price forever? No. Silver is global, demand is global, supply is global, and markets are competitive. But can a dominant institution shape short-term price behavior, volatility, and liquidity, especially in a relatively smaller market? That's the concern. And that's why this topic won't die. The historical plot twist. The Hunt brothers, 1980, and why silver still feels rig time for a historical connection that'll make you go, wait. In the late 1970s, two Texas oil billionaires, the Hunt bros, tried to corner the silver market. They bought futures. Silver prices exploded upward. For a moment, it looked like they were going to pull off the ultimate squeeze. Then the rules changed. Margin requirements went up. Trading conditions tightened. Liquidity dried up. Prices collapsed. Hard. It was one of those moments where regular people learn painfully that markets aren't just supply and demand. Markets are also rules, leverage, and who gets forced to sell first. Why does this matter today? Because silver still carries that trauma in its DNA. Every time there's a big silver rally, people ask, is this real demand or just leverage? And every time there's a smashdown, people ask, was that normal selling or paper pressure? So when modern traders look at a giant institution sitting at the center of silver, they remember 1980 and think, so cornering is only illegal when the wrong people do it. Now, modern today's market is not 1980. The hunts were a concentrated speculative attempt. Modern bullion banking is a whole ecosystem, but the emotional memory sticks. And it's part of why JP Morgan's name triggers such strong reactions in the silver community. The part people skip. Enforcement, spoofing, why trust is low. Let's talk about the reason this conversation goes from finance nerd to group chat alarm. Over the years, regulators have brought cases in the precious metals space involving illegal trading practices. Like spoofing placing orders you intend to cancel to influence price and create a false sense of supply or demand. And yes, JP Morgan has been connected to enforcement actions involving traders and precious metals. That history is real, and it matters because it affects confidence. Now, I need to be very clear. That doesn't mean every move is manipulation. And it doesn't mean the market is fake. It means what it always means in markets. If incentives reward aggressive behavior, some people will get aggressive until someone gets caught. And here's the Gen Z translation. If a video game has an exploit, somebody's going to use it until the patch drops. So the bigger question isn't just did anyone ever cheat? The bigger question is, what's the structure of the game right now?
Because structure determines what's possible.
If silver price discovery is heavily influenced by a high-leverage paper market, then it's naturally more sensitive to large order flow, positioning, and margin changes, algorithmic trading behavior, and liquidity gaps during fear events. And that means even without a cartoon villain, you can still get price action that feels unnatural. So when people say JP Morgan took control, a more accurate, less clickbait translation is, a small number of major institutions have outsized influence in silver. S pricing mechanisms in JP Morgan is consistently viewed as one of the biggest. That's the core idea, how control actually works in real life. 7 mechanisms. Now let's get practical. If you're watching this, you want to know. Okay, but how would a big bank influence silver? Here are 7 mechanisms, not conspiracy, just market mechanics. Number 1, liquidity dominance. If you're one of the biggest market makers, your quotes and spreads shape how easily everyone else can trade. Number 2, inventory advantage. If you can source and store large amounts of deliverable silver, you can meet delivery needs when others can't. In commodity markets, that's power. Number 3, information advantage. Seeing flow, especially institutional flow, matters. If you see where big money is leaning, you have to predict the market as much as you have to react faster than everyone else. Number 4, leverage and margin dynamics. Futures markets are sensitive to margin changes. When margin goes up, leveraged longs may have to sell. If you understand that landscape deeply, you can anticipate forced moves. Number 5, options positioning. Options can create gravitational pull around certain strike prices near expiration. It can influence price behavior in ways that look like magic until you learn how hedging works. Number 6, ETF creation redemption mechanics. Big institutions involved in the ETF pipeline can influence short-term supply demand for physical allocation, depending on flows. Number 7, narrative control. Yes, narrative is a mechanism. Mainstream commentary constantly frames silver as just a barbarous relic or just a meme. You affect who participates. Attention is a form of capital. Put those together, and you don't need a secret meeting in a volcano lair. You just need a concentrated structure where a few players have scale. That's why silver is so controversial. It sits at the intersection of finance, industry, and belief. Okay, so is silver suppressed? The honest answer, let's address the elephant in the comments section. Is silver suppressed? The honest answer is, it depends what you mean. If you mean, can big players influence price in the short term? Yes, that's true in almost every liquid market. If you mean, is there a permanent artificial cap that ignores supply and demand forever? That's harder to claim. Over long time frames, real fundamentals matter. Mining supply, recycling, industrial usage, investment demand, interest rates, and currency strength. But here's what can be true at the same time. Silver can be structurally prone to paper-driven volatility. Concentration of major players can amplify that. Bad behavior has existed historically in precious metals trading. And despite all that, silver is still a real asset with real industrial demand. So instead of arguing in absolutes, it's totally rigged versus everything is perfectly fair. A smarter framework is silver is a highly financialized market where paper claims can dominate short-term pricing and where concentrated institutions can have outsized influence. That's not clickbait, that's just how the plumbing works. What could break the grip? The 5 triggers to watch now. Let's talk catalysts, because if you're here, you want to know what could change the game. Here are 5 triggers that can force the silver market to reprice, regardless of who's in control. Number 1, a sustained industrial demand shock. If industrial demand rises faster than supply, can respond, especially in solar and electronics, physical tightness starts to matter more. Number 2, a real persistent supply constraint. Mining projects take years. Permitting takes years. Costs rise. If supply can't scale, price pressure builds over time. Number 3, a crisis of confidence in paper claims. If enough big money insists on delivery or prefers allocated physical exposure, it can stress the system. It's not guaranteed, but that's the pressure point people watch. Number 4, macro conditions. Inflation plus rate expectations plus dollar moves. Silver often reacts to the same forces as gold, but with more chaos because it's smaller and more industrial. Number 5, a narrative flip. This sounds silly until it isn't. If silver becomes cool against serious institutional inflows, not just meme hype demand can surge fast through ETFs and futures. I'll add a bonus. Regulation and transparency changes. If rules shift around reporting, position limits, or market structure, behavior changes. So no, This isn't just wait for the secret squeeze. It's watch the fundamentals and the pipes. Practical advice. How to think about silver without getting wrecked. All right, let's land this plane with the part that actually helps you. If you're a normal person with bills, a 401k, and a group chat that panics every time CPI drops, here's how to approach silver intelligently. I'm going to give you 9 practical rules. Number 1, decide why you want silver. Is it inflation hedge, portfolio diversifier, speculation, collecting? If you don't define the goal, you'll buy high and rage sell low. Number 2, understand the product you're buying. Physical coins are different from ETFs. ETFs are different from futures. Futures are not a vibe, they're a chainsaw. Number 3, don't confuse price with availability. In stress moments, the spot price can do one thing, while physical premiums do another. That's not magic. It's market friction. Number 4, position size like an adult. Silver is volatile. If your position is so big that a 10% move ruins your week, it's too big. Number 5, if you're buying physical, care about total cost, premiums, shipping, spreads, storage, those are real. You don't get to ignore them because a guy on the internet said to the moon. Number 6, if you're buying paper exposure, read the structure. Know what you own. Know the risks. Know the mechanism. Track silver is not a full explanation. Number 7, zoom out on time horizon. Trying to day trade silver because you saw a threat is like trying to ride a mechanical bull while doing your taxes. Number 8, diversify your hard assets basket. If you're worried about currency or inflation, don't make it a single metal religion. Think broader. Cash management, tips, diversified commodities, quality equities, emergency fund. Silver is a tool, not a personality. Number 9, stay curious, not paranoid. Yes, powerful institutions exist. As history shows, bad behavior happens. But paranoia makes you predictable, and the market loves predictable. And that's the real takeaway. The best defense against control is understanding structure and managing risk. Okay, now that we've covered why silver matters, let's speedrun how the pricing system actually works, because this is where people get misled. All right, with that foundation, let's talk about why one specific name, JP Morgan, keeps popping up like an unskippable ad. Before we go full 2026 internet meltdown, we need a quick history lesson because silver has been chaotic for decades. Now here's where trust really breaks down. We've got to talk about enforcement and what regulators have actually said. So let's make this concrete. What does control look like in real market mechanics? Cool. Now the big question. Is this all suppression? Or is it something more boring and structural? All right, doom is optional. Let's talk about what could actually change the game from here. And finally, let's turn this into practical moves you can use. Because information without action is just anxiety. So here's the bottom line. Silver is a weird, emotional, industrial, financialized metal, small enough to be pushed around, important enough to matter, and complicated enough that most people never learn how it's priced. JP Morgan didn't buy every ounce of silver on Earth. But the reason people say they took control is because modern commodity markets reward scale. And when one institution becomes a major node, trading, liquidity, inventory, infrastructure, people feel that influence in the price. The real lesson isn't panic. The real lesson is learn the plumbing. Respect the volatility, and don't let internet certainty replace your risk management. If this video helped you understand silver without the conspiracy brain fog, hit the like button. It tells the algorithm you want more deep dive money content that doesn't treat you like a toddler. Subscribe if you want more breakdowns on how markets actually work, commodities, banks, ETFs, all of it. And comment silver if you want to follow up, where I compare physical silver versus ETFs versus futures, like what you actually own, the pros and cons, and who each one is for. Also send this to the one friend who keeps saying silver is definitely going to $1,000 next week because they need a hug and a spreadsheet.